The Indian rupee woke up to a historic low today, slipping past the 90 mark against the US dollar for the first time ever. It's a symbolic level, one that signals more than just a number on a currency chart. Over the last few days, the fall has been steady. On Tuesday, the rupee closed at 89.95 versus the dollar, after losing 42 paise in a single session. And if you zoom out, the picture becomes clearer. The rupee has already fallen around 5% this year. In fact, it's now one of the worst performing currencies in Asia. But here's the twist. This decline isn't happening because India's economy is weak. Quite the opposite. India's GDP growth has been stronger than expected. The real pressure is coming from outside. Higher US tariffs on Indian goods, delays in a key trade deal with Washington, and foreign investors pulling money out of Indian markets. Foreign investors have withdrawn nearly $17 billion from Indian stocks this year. Foreign direct investment has also been muted. When money moves out, demand for dollars rises, bringing the rupee under more strain. Add to this a widening trade deficit, which has crossed $40 billion in October, and a need for the dollar only grows. And that demand matters because India depends on imports for essentials like fuel, electronics, cooking oil and fertilizers. When the rupee weakens, these imports become costlier. A weaker rupee, simply put, is like having a smaller shopping budget when prices abroad stay the same. Domestic markets have felt this pinch too. The Nifty slipped below the 26,000 mark. The Sensex lost nearly 200 points as a falling currency raised concerns about inflation and foreign money exiting. But for most people, the real impact will be felt at home. Petrol and diesel may inch up in price. Gadgets could become more expensive. Students paying international fees will immediately feel the jump. Vacations abroad will cost more. Even home loans could eventually face pressure if inflation rises and interest rates shift. So, why is the Reserve Bank of India, the country's central bank, not stepping in aggressively, as it has in earlier currency crises? Because something has changed. The International Monetary Fund recently reclassified India's currency system from stabilised to cruel-like. That means the RBI is guiding the rupee's movement, not fighting every fall. Rather than drawing a hard line at 90 or any other level, the RBI now prefers gradual, controlled depreciation that reflects the country's trade realities and inflation gaps with the world. In simpler terms, the central bank is choosing patience over panic, and that's what makes this moment different. The dollar isn't unusually strong. India isn't short of reserves. The RBI isn't scrambling. Instead, the rupee's slide seems to be part of a long-term adjustment, a slow reshaping of India's place in a shifting global economy.
The dollar weakness next year should support mild rupee appreciation, and that could pick up pace around seasonally favorable first quarter for rupee.
For now, the currency is signalling that the world around is changing, and India needs to adjust with it. The next few weeks will reveal if the rupee's fall is just a passing phase or the start of a new normal.
They promised glory. They delivered fear. They shaped nations. They scarred generations. From brutal purges to propaganda machines, from stolen power to violent falls from the throne. Welcome to The Dictator, a series that strips away the myth and then exposes the men behind the tyranny. History remembers their power. First Post reveals their truth.